And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, traders. Welcome to the Coach's Playbook, a reduced edition today. I'm joined by Hogue and JD, while Mick and Dan. Oh, Mick's on parental leave, but Dan, who knows what he's doing. So nice to have you guys.
Good to be here.
Yeah, we got a great cheeky topic today. Does size matter, or is it the motion of the markets? We will figure that out. It's an important thing. Obviously, the size you trade does matter, but it's not a competition to see who can swing the most or stuff like that. That's for the birds. But we figured we'd start today by talking. There is a lot of motion in the markets right now. We had the VIX spike above 30 yesterday, come back down. And a lot of that has to do with, you've obviously heard of some banks getting shuttered, some mid-sized banks, our good friends at Silicon Valley Bank and Signature Bank. Did you guys see, I think that Barney Frank is on the board at Signature Bank?
Is he really?
I think he was.
Huh.
That's too good. But anyway, we thought maybe we'd talk a little bit of the differences between what's happening now. And obviously there was some people were all scarred by what happened in 2008. And let me start by saying they're two completely different things. One's a credit crisis. This, I dare even call it a crisis. Any of you who are trading interest rate products out there, you are undoubtedly better at doing it than Silicon Valley Bank. And I'll start by saying this is kind of funny to me, because there was this thought. I saw somebody brought up a tweet from 2016 from someone in Silicon Valley that was along the lines of the Silicon Valley ethos being like, we can do what you can do, but you can't do what we can do. And the person saying generally they'd found that to be true. They can do boring things like banking and stuff like that, but we can't. And admittedly, I cannot build a microprocessor. But it turns out maybe they're not so good at banking, or at least hedging a fixed income book. I just don't know. Hogue, I'll let you start because you're the most experienced in this. It baffles me that a bank of that size was not able to hedge a fixed income book, but I'll let you take it away.
Well, everybody gets a little bit over their skis once in a while, right?
Mm-hmm.
They just got caught. And I think I think there's a little bit of arrogance in what they did and what they thought they were going to be able to do. It was poorly managed. And you've got all these tech startups, you got all this technology out there, and like you said, Jack, they can do what we can do, but we can't do what they can do, right? They just thought it would never happen to them. I've been guilty of that. I can imagine.
Sure.
I can admit. So, they overhedged, and when rates started going up, that hedge went south, and they weren't bringing in enough cash, and somebody figured it out. Possibly some of the executives of the bank figured it out a couple of weeks ahead of time, but it didn't have to happen. It was just poor management.
Yeah.
Oversize
indeed. Or just, in a macro, we could be talking about different things. I think that they were just dramatically underhedged, at least as far as interest rates, because so I traded for 7 years. I traded fixed income, treasuries, stuff like that. And one thing that any knucklehead at the Chicago Board of Trade, not a titan of Silicon Valley, should be aware of if they're trading interest rates is that selling begets selling because of convexity trade. So big players in the market, not us, not the pea shooters out there. But what you should be doing, that it seems that they were not doing, is when the price of, say, treasuries is going down, that means the yield is going up. Okay. And as the price goes down and the yield goes up, as it gets lower, you'll actually see incredibly more selling by giant things. We're talking mortgages, right? Mortgage players, bank players in their case, because they weren't really doing loans. They were mostly investing in bonds. The idea being that, you know, if I give Doherty a 3% mortgage and now it's at 7%, right? I'm losing money essentially on that for the next 30 years, unless I start selling to hedge when it gets to that point. And it seems to me that they just, for whatever reason, were incapable or just wishful thinking, not doing that correctly. I think one of their C-suite people was like the former CFO of Lehman Brothers, which you can't make up.
Yeah.
But as I kick it over to JD, though,
Jack, I have one question for you, and I think a lot of folks that are going to watch this are going to appreciate this. Why, when rates go higher, does price go lower in treasuries?
Well, that has to do with the yield to maturity, right? You have to go into what a bond actually is. And by the way, bonds are a delightful product. They don't move fast, but they do recently. Tons of liquidity. It's considered, I hate using smart and dumb money, but it's a lot more institutional players in it. The idea is that if you buy a bond with a coupon payment on it, right? You buy it for 100, let's say, they're giving you a stream of payments for however many years until the maturity of the bond, right? Now, if interest rates rise, those future payments are not as attractive. And so I would pay less for them now. So you can get into, theoretically, the price you pay for it could get close to zero or something like that. So that's why yield and price are inversely related for bonds, something to remember. And as our former Lehman / Silicon Valley Bank guy, he's now experienced two different crises of his own making. So JD, maybe you could tell us, you traded through 2008 and stuff like that, kind of what the differences are here.
Oh, okay, we'll do a little history lesson here. I don't think they're really comparable. They're two different things, just like you said, the 2008 credit crisis really started, in my opinion, in the aftermath of, 9/11. There was a lot of negative sentiment floating around at the time there. The Fed responded with stimulus by lowering interest rates again. I mean, if you remember in the 1980s, interest rates were over 20%. I think by the year 2000, they were below 5%. And then after 9/11, to stimulate the economy, they started lowering more. This in turn just created this massive housing boom. For many years, the housing market kept the U.S. economy's head above water and just created a massive, I guess you could call it, artificial wealth, right?
Mm-hmm.
And that's when, the bottom dropped out. The party on Wall Street ended with a few huge bank failures, massive bailout courtesy of the American taxpayers, which we're still kind of dealing with the ripple effects of now. You mentioned Barney Frank on the board of Signature. I mean, one of the most sweeping financial regulation reform bills that passed 2 years after the financial crisis in 2010 was the Dodd-Frank Act, which put just this giant chokehold on the trading industry. I mean, I looked up a couple stats before this. Before 2008, there were close to 600 member clearing firms at the Chicago Mercantile Exchange. That number dropped to below 25 less than 2 years later by the time the Dodd-Frank Act was passed. So hypothetically, if there were 1 million open active retail futures trading accounts in 2008, by 2010, you could say that there were less than 300,000. My math might be a little off there, but I mean, it was just a massive erase. It was impossible for a retail trader to open an account without a significant amount of collateral to put up. Clearing firms just weren't willing to take any risk. And that still has been like the biggest ripple effect from the 2008 crisis that I've seen. It's only been in the last 5 years or so, I want to say, pardon me, that we've seen retail traders really start to make a comeback in the futures markets. And with the bulk of that just coming in the last couple of years during the COVID-19 pandemic back in 2020, we saw a huge boost in retail trading accounts opening. And I just think it's completely different. It was on a different scale. I don't think we're going to see those kinds of massive bank failures. I don't think every major bank is exposed to the tech downturn the way Silicon Valley Bank was. It's just
they're not
a lot
invested in the same things.
Yeah.
On the smaller level, it's where they got into trouble at Silicon Valley Bank is with their bond portfolio in a way that bigger banks face more credit risk, right? They're actually just making the loans and things like that. I'd also like to point out the reason I'm bringing this up is because you want to have good stories out there, good content. I saw all sorts of BS over the weekend, essentially, of bank failures. This is 2008 part 2, stuff like that. You can see the big difference in the market. I saw someone out there discussing like, okay, here were the 3 job prints before Lehman collapsed. It was like minus 300,000, minus 350,000. The economy was already swirling the bowl at that point. Furthermore, as we mentioned, it was a completely different contagion they were dealing with, where these things were all just worthless. Like the assets at the Silicon Valley Bank are still valuable. People are going to be made whole on it. So I think that we're good here. I'm glad it has not gone to so any bank with less than $250 billion in assets doesn't have to face the same regulation the big banks do. So hopefully it stops here. But where this comes into your trading, and we'll get into our topic of size here, is that this did kind of throw a wrench into what we could expect the Fed to do next week. Now, CPI came in today pretty much on the screws, and there was a lot of thought leading up to this that the Fed was going to cut rates by 0.5%. It's next week, right? When is the next
Wednesday.
Next Wednesday was going to cut 0.5 point, which would have been big. But now most of the financial punditry and banks are saying you can almost count on a quarter, because given what happened with these banks, they don't want to be seen as exacerbating this too quickly. Ho, you have any thoughts on that hypothesis?
Yeah, I mean, I've been reading a lot of talking heads, listening to a lot of talking heads about this, and I mean, I'm hearing ideas of no rate hike. I don't think that's going to happen. I think the market's already kind of priced in 0.25%, and if they do a 0.5%, I think they're crazy. I think they're putting more stress on the banking system, and I don't see that. I don't see them doing that. Of course, I don't judge that. They don't listen to me, but
yeah. By the way, I forgot to mention the other huge difference between this and 2008. After Lehman, it wasn't like Monday the S&P closed above its 200-day moving average, where it's sitting right now, or the VIX went down 10%. So it's very different market reactions. I think going back to the Fed, yes, and I think they're starting to see some data that even though CPI is slowly going down, but it's still hot. I have seen, when you look at some of the more out there predictors, this one's not. The wage growth slowed a little bit in the last one, and job postings have been going down. I saw Facebook's cutting another 5,000 jobs, or 10,000 jobs, and 5,000 open jobs being removed. But a lot of these metrics that are these indicators that measure sort of the job websites and stuff like that, I think those postings are coming down. So those are all things I think that they are seeing. And I mean, no one likes people losing jobs.
No,
but
right.
Yeah, it's a delicate balance. So I think 0.25% is in there. And I think as long as nothing crazy happens, I think the markets will like basically nothing crazy happening in the next week.
Mhm.
I think no news is good news until the Fed announcement.
I think overall the markets handled this situation actually surprisingly well. And I agree. You know, if we can get some of this uncertainty out of the markets and lighten up a little bit on the pace of rate hikes, I think the market's going to like that.
Well, speaking of lightening up, we promised we talk about size. Let's talk about size. And we discussed the VIX a little bit earlier. And, you know, at a bare minimum, before we get to the account management part of it, if you're trading equities, your size that you're trading should be somewhat proportional to the VIX. You're not trading the same size when the VIX is at 30 that you are when it's at 15.
No, for sure.
Oh, absolutely not. But as far as just like an account in general, Hogue, how do you look at how much capital you would want to have to trade a certain number of contracts?
It's a great question. You know, I'm of the school of thought, if I have 10,000 in my account, I'm a one lot trader.
Yeah.
You know, if I'm going to be trading any bigger than that, it's, you know, I need, incrementally more than that. You know, if I have 15, I'm okay with 2. If I have 20, I'm okay with 3, and then so on and so forth. I can kind of cut some of the margin that I have in the account a little bit, the bigger I get. But, you know, there was a time when I was really trying to become a bigger trader. I wanted to be a big, 10, 20, 30, 50 lot trader in the S&Ps. And I was a prop trader. I had the backing to do so. And so, it's always about, expanding your comfort zone, expand your comfort zone, trade a little bit bigger, do this, that. And I just wasn't comfortable getting anywhere past a 5 lot. I remember the first time I put a 5 lot on, I was scared to death. I was shaking so much I couldn't even write down the trade. Anyways, so I called my dad, who was always full of good wisdoms, and I said, Dad, I'm trying to increase my trade size. My backers want me to increase my trade size. I'm not comfortable doing this, or at least not yet. And he said, there's a lot of people making a very good living trading 5 contracts. So you don't have to be trade big to make money. It's more about managing your trade size according to the risk on the trade. If you have a trade that is very close to a point of invalidation, and you can risk, $400, $500 on that trade by putting on 4 contracts, then you put on 4 contracts. If things are more volatile, the VIX is higher, you're going to have more risk per trade. You're probably going to be looking at bigger risk on that trade. So you're going to be trading smaller. I think, trade size is based on the risk per trade per contract. If I'm comfortable risking $500 in one trade, and this is just for ease of explanation, if I'm comfortable risking $500 on a trade, and I have a trade where I can risk 125 on one contract, I can trade 4 contracts. And some of that is related to the amount of money you have in your trading account. You don't want to risk, too much of a percentage of your account per trade, but that's kind of the way I look at it. If the trade is cheap, I can trade bigger. If the trade is expensive, I'm going to trade smaller.
Now, because I'm less familiar with how things worked on the floor, when you were doing prop trading, were you holding positions across sessions, or were you flat at night?
Flat at night. I started out as a pure scalper, working the bid, working the offer, hoping I get hit on both at the same time.
I was thinking that when you're given the numbers, so that you're talking about, $10,000 one lot trader when not holding at night.
No, not holding overnight. No, for sure. But, I have over time, as I matured as a trader, I started looking for a bigger, longer time frame, day time frame opportunities, always flat at night, unless I had an out trade.
Yeah. Everything that I traded were like spreads that were hedged. So we were always holding things overnight, but that's very different. I don't see much of a reason unless it's very small size and you're going for some long-term play to hold anything overnight, if you're especially the outrights. You're just that's a real Jesus take the wheel strategy, right? I mean,
and I've had a couple of those, but they were accidents.
of course. JD, what about you?
Well, I understand what you're saying. They used to say if you could trade small, then you can trade big, but that's not always the case. You could look at my statements from back in the day too, that'll prove it. But I would say it doesn't matter if I'm trading 5, 10, or 20 lots. When situations like this occur and there's a spike in volatility, like I'm back down to a 1-lot trader until I can get in a comfortable groove, you know. This is a time where smaller traders need to be nimble and stay on their toes. This isn't the time to be loading up and start swinging for the fences. You know what I mean? Right now, when we have Fed policy and news headlines reeling the tape, it's not really the best scenario for success for smaller retail technical traders. So that's my standpoint until things start to calm down and we have a better sense of, we get a better grip on the markets. I am cutting my size down significantly.
Sure, because your levels are going to mean less too. When there's real shocks going on in the market, you know, no one cares what a certain moving average is or swing high or swing low. It's not the same sort of trade. You know, if a bank collapses midday, people are going to do like that. Was a crazy move. I think the biggest move since the 80s. You know, you talk about the blowout levels don't matter trade. How about the 2-year yields? That was a crazy move where basically I think the hypothesis right now is that that's just like a lot of not even traders. That's just a lot of people with cash around or just piling into something with yield right away with this kind of panic. It's coming back a little bit, but that was a huge upward move in price, down yield, as we mentioned earlier in the 2 years. Definitely a chart to take a look at if you're interested in that sort of thing. Yeah, I'm trying to think about other things as far as size. So we mentioned mostly day time frame. I think we can safely say overall that we see way too many people trading too much size based on their account value and very few people trading too little.
Less, right?
Yeah,
that's
less.
That's one of mixed things is, you know, if you're trade smaller than you can.
Yeah.
But you guys noticed yesterday that that move to the downside in the S&Ps stopped 3 ticks from weekly kickoff low. And then we opened and we stopped short of there. It was a wonderful opportunity if you were looking for a buying opportunity.
Check out those levels. Hogue spends all day sweating over those levels, so better use them.
Once in a while, even a blind squirrel finds an acorn.
Yeah. I think the real poisonous thing to avoid, though, is I would call it like the culture of size, where size itself becomes a goal for some people. I swear I work with people who I think cared less about the money they made compared to how much size they could put on. Like,
because it was cool.
It was cool, you know, to talk on the phone and tell someone to do X with X size. Nobody else cares, everybody. No one cares. If that's something that's an allure to you, I think that you have to look inward and think, what has happened to me? what is going on in my soul such that I feel that I will be a more desired person by others if I trade 20 lots.
Big.
Yeah. I don't know. There's very few reasons to do it. I mean, I know we have like a 15 contract limit in like the larger combine, but I'm always thinking it's like, I don't know when I would trade. Even when I was trading with proprietary money, I would be, and this is in bonds, I would be trying to get hedged very quickly if I was ever outright 15 ZNs or something like that.
It's very scary.
That's scary. That doesn't feel good.
Very scary.
Yeah. So, I mean, you got to trade what you're comfortable with. And the vast majority of people are trading, whether knowingly or unknowing, they are trading outside of their comfort zone by trading too big for what they can reasonably lose. I guess that's what it comes to.
And what does that do to their decision-making process? How much harder is it to make a good trading decision with 1 on than it is with 5 on? You know, it's like you put 5 on, it's going to change your decision-making process. It's going to be hard to make the right choices.
Yeah, we have a question coming in off the Holden line. How would you react to a trade that you have a high confidence it would work? Would you max out your size even if the volatility environment says the trade's small? I'll start with this one. I would find that to be an unusual situation because if there's high volatility, I would be very unlikely to have supreme confidence in a trade. And even if I did, I would cap. I would have my size cap lower, like whatever my max size was a week ago when it was less volatile. I would have a new mental size as my max, and if I was confident in that, I'd use that. I have a story about this, but Hogue, you can go if you have anything to say there.
In volatility, if I see a high confidence trade, I'm probably going to skip it because confidence in these situations and in my experience have provided losses more often than wins. If I see something and I'm really confident, like, oh, this is a layup, it means everybody else is seeing it and it's never going to work. So if I'm going to take it, I'm going to size way down.
Yeah, go ahead, JD.
Oh, I would agree with that 100%. I think one of the biggest things about high volatility that people aren't thinking about is a lack of liquidity sometimes. Just because you put a stop order in at a specific price does not guarantee you a fill at that specific price. So if you're loading up on size and you put your stop in at a level that's, your exact loss limit for the day, you have the potential to get seriously burned on that stop too. So you have to keep things like that in mind.
Yeah. Before we sign off, I'd say the only exception to this, and only happened to me once, this is extremely rare, is if you just happen to be in the absolute right place at the right time for like an absolute, I would call it ticker bomb, right? Like something, I think nowadays, this was 10, 12 years ago now, technology is probably such that this is harder to do, but occasionally you're just in the exact right place to see something on Twitter, for instance. That's why I always have the Twitter up and some accounts like that you see it instantaneously and the market's still liquid and you can just cannonball it. Okay. I traded full time for 7 years. That happened once. And that was probably my best day ever. But in the same room of 150 traders, there was a lot of people that ended up being their worst day ever because, those things are few and far between. So, I used to have this probably isn't even good advice. I don't even know why I'm saying. I used to have this sort of like my doomsday spreader on my machine that was just like, would just chuck long all sorts of front end treasuries into the market. But that's not a button you ever want to use. And I'm already regretting bringing this up right now. Don't do that.
the panic button.
That's the panic button. That's I don't want to be ghoulish to go into what would be reasons to hit the panic button, but it's there. Yeah, it was just chuck like shorty ass long front end of the curve futures. But yeah, I'll talk about that more some other time. But I hope that answers your question. One more question, if you guys got a minute here. Just signed up with Topstep and recently started swing trading stock, but want to learn futures. I have a scheduled call with Eddie. Any recommendations? Yeah, take the call with Eddie. Eddie's great. Check out our free coaching options. Ho, you want to get the times for those?
Yeah, the group coachings are in their Zoom meetings. They are on Mondays and Wednesdays at 12:30 Central.
Great.
I'll look forward to seeing you there.
And check out the new, we got a beginners page under how it works at topstep.com now. On it, we have all 16 hours of Hoag's trading foundations course for free if you want to take a deep dive into futures there. So we got to wrap it up now. It was nice talking to you guys. Hoag,
Good
you want
talking
to take
you
us home?
too. Sure. You're no matter what size you trade, no matter how big, no matter how small, you're a trader, and that makes you cool.
I like that, Hoag. All right, we'll
Trade
be here
well.
next Tuesday. Trade well, everyone. Stay safe.